always enjoyable to be able to assemble here to look forward. And we've also enjoyed the pleasure of hosting Bloomberg here. I think this would be our 10th year, actually. Some of you may remember when in the monsoon of 2008, Carlos, or 2009 perhaps, when we had a studio actually on site outside. After 2 years of sub 50-degree weather and rain, they thought maybe it would be better just to send the hosts instead and see what Florida brings us. Well, today it's a great pleasure to be able to welcome Josh Saul. I'm going to let Josh introduce his panel and lead our conversation on what lies ahead. Please welcome Josh.
Well, hello everyone. I'm Josh Saul from Bloomberg News. Excited to be here today with an extremely smart panel to talk about for this roundtable on the restructuring outlook for 2019. I thought we'll each introduce ourselves just real briefly and give a quick idea of what our focus is. I was going to go first. I'm Josh Saul, and I'm a distressed debt and bankruptcy reporter at Bloomberg News in New York. In the past year, I've focused on writing about American Tire, Sears, Windstream. Lately, a number of helicopter companies have been pretty interesting. Basically, my job is to be first with kind of breaking news and compelling stories about those sectors. And yeah, happy to be here today.
Cool. My name is Duncan Bourne. Excuse me. I'm with Winchurch Capital. We're a middle market private equity firm located in Chicago. We're investing out of a $1.3 billion fund currently. It's our fourth fund. We've been in business since 1999 and have been investing in all phases of our economic cycle. When time gets tough, we invest more in distress. When times are good, we invest a little bit more in just merely hairy situations and some growth opportunities as well. So I'm happy to be here as well, and thanks for hosting this.
Thank you.
Great. Good morning. I'm Deirdre McGinnis. I'm a senior managing director at Epic Global. I run a national sales team for both restructuring and class action. And I look for strategic relationships and increasing our depth of products for the restructuring community. And I'm happy to be here. Thank you.
Good morning. I'm Andy McGee, the CEO and co-founder of Alistar Capital Finance. We came up with an idea back in 2011 that we could take some of the sophistication from our larger institution experience, both bank and non-bank, and drop it down into the middle market. So our focus is really doing commercial finance type transactions, story transactions, opportunities where there is a real disruption going on in the business and provide capital to that situation. So we're glad to be here, and thank you for the opportunity.
Good morning, everyone. I'm Nancy Peterman. I'm a shareholder with Greenberg Traurig. I'm based in Chicago. Typically, I'm a restructuring lawyer, so typically you're going to see me either on the company side or on the buyer side, whether that's trying to do a loan-to-own transaction or simply coming in to buy distressed assets. I do that in and outside of court. Lately, I have spent almost all of my time in the healthcare space, so I seem to be in skilled nursing cases all around the country.
Good. Hi, my name is Ted Hirschfield. I'm a director at B. Riley. At B. Riley, we have a restructuring group. We also have Glass-Ratner, and we work together on a lot of cases, but we're on the banking side, so we can do not only the advisory work for both debtors and creditors, we could also raise capital, and we do on the healthy side or the stress side, we do a lot of work when things are not as tough, and when things are tough, we focus more on the restructuring world, which right now about half the things I'm working on are real restructurings, and the other half are more healthier capital raises and M&A opportunities.
Thank you. Now that we have an idea of what everyone's focus, let's get started. Andy, I wanted to ask you, where do you look for business opportunities, in a good economy? How does easy credit change your job, looking forward into 2019?
So I'll flip that and go to how does easy credit change our job, and then where do we look for credits?
Great.
There's been a huge influx of capital. When we started the business in 2011, providing capital to a company that had a big story was a unique platform. That's no longer unique. There is capital that's come in from banks. It's also come in from the non-banks and institutional market. So there's been a significant shift in liquidity and the ability for borrowers to access that liquidity. Our primary ability to access businesses originally was bankruptcy attorney, turnaround consultants, bank workout departments. As we've moved through the recovery, the bank workout departments have become the bank hold on to them department. We'd be mid-deal and the bank was kicking them out. And the next thing we knew, we got the call, the bank has decided they're going to hold on to that client because revenue became such a driver for that business. So it's changed. We continue to do referral source driven business with accountants, attorneys, turnaround consultants, investment banks. We really are a referral source driven business, but the level of competition has ratcheted up significantly. It's a completely different world, and you're having to, we're partnering with non-bank players who rolled out their platforms and said, hey, we're going to clip 9 to 11% coupons, and realized quickly that that market didn't exist because of the excess liquidity from the banks and the driving down of the margin. And so they're coming back in at a lower coupon. They need to partner with someone on a first out basis that gives us a little less risk. They get to skim a little bit of that fee. They get their 9 to 11%. We get our acceptable yield, and it works for everybody.
Wow, thank
So
you.
it's been a big change.
Interesting. Does anyone else have any insight on that matter they'd like to add?
To his point about everyone want to hold on to everything, there are a couple of things that I'm working on that 10, 15 years ago, they might have been restructurings, and now we're just negotiating with the lender. And you're converting some of the debt to preferred. And you're looking at the cash flow and what they can actually support. And you're just changing what the capital structure looks like, but you're remaining with the same institution. So that's a lot of what we're working on.
I think a big part of this has been these non-bank lenders that have entered the market. They came in before the last downturn, but have grown substantially since then. And that's been a big effect, made lenders, bank lenders, a lot more competitive, obviously. And there's a couple of different flavors of these non-bank lenders that have really added to liquidity. And I think it's also made it so that even companies that find themselves in a workout group, find themselves able to be refied. And I think that's had a big effect on the restructuring community as a whole as well.
Yeah, I'll just say, I have a case right now, which is it's a group of 14 skilled nursing facilities in Illinois. Illinois is one of the worst states to own skilled nursing facilities, and we actually refinanced the debt during the receivership. So we had, healthcare is a hard industry, first of all, to find a lender, and secondly, to actually get a lender to come in and take out our existing lender and increase liquidity for purposes of supporting the receivership.
Wow.
So yeah, that kind of gives you a sense maybe of what's going on in the lending market.
Why is, maybe a little off topic, but why is Illinois one of the worst states to own a skilled nursing?
Really slow pay.
Okay.
They're out of money.
Yeah, and the state is bankrupt. Yeah,
Right.
that's a
Yeah,
minor
it's almost
point, but yeah.
Yeah, the funny thing is, you can get a loan, though, if you're owed money by the state, right? You can go get a
Yeah.
loan, right?
Yeah.
And then the state ends up paying that cost. It's it's a nutty place.
It is.
Don't get me started on that. I live in Chicago. Don't get me started.
Wow. Okay.
One other thing, though, interesting note, I think, though, is that, when you look at sort of default rates and you look at, sort of other standard ways of looking at how many companies are in distress or are in trouble, I think that the liquidity that's available, I think, has sort of undervalued that statistic. I think that, there is a fair amount of, restructurings, distress, turnarounds, all that kind of stuff going on all the time. I think it's underreported, though, relative to sort of conventional measures that we've historically looked at.
Interesting. Did you have a thought, Deirdre?
From my perspective, I think when there's ample liquidity, and for a claims administration company, we thrive when companies file for Chapter 11. I look at ample liquidity as opportunistic for transformative transactions. So our securities team can do out-of-court exchanges and do, other types of administrative functions which support those efforts. So it's kind of like making lemonade out of a bucket of lemons until volumes come up.
Got it. Moving on, which industries, I'm interested to hear from each of you, which industries are you watching most closely for opportunities in 2019? And which do you think will be under stress in the, in the coming year? And Nancy, we can start with you.
Yeah, well, I feel like I'm on the healthcare theme, but I will say healthcare. So I've spent a lot of time over the years working in the healthcare space, and this is probably the first time in 25 years that I've been practicing where really the only thing I have on my desk right now is healthcare cases. They are all in the skilled nursing area right now, so unfortunately, there's not a lot of acquisition opportunities there. Most of those are, we always describe it as the company being the caretaker. Oftentimes, the company doesn't own the underlying real estate, or even if they do, there's so much mortgage debt against it that there's not a real workable solution. So the company's kind of the caretaker as they work with the lender and or landlord to facilitate transition to a new operator. Deals get recut, debt gets restructured with a new operator, leases get restructured with a new operator, and those homes then continue on. There's very few lately closures in the skilled nursing area. I'll be interested to see if that changes. I think there's too much capacity, in particular in certain states. So there's a lot of activity right now in Texas, which is not, like most states, Texas is not a CON state where you have to get a certificate of need, where they restrict the number of beds. And so one case I'm working on right now, senior care, it has roughly 100 skilled nursing facilities, and they compete with one another because they might be within a block of each other. So they're competing with one another on census, which drives down the census at each facility. So we're continuing to watch the healthcare space. Right now, it's really kind of senior living, post-acute, that there's pretty heavy activity. But there likely will be, just like there is every year, other sectors of healthcare that ultimately get hit with the stress.
Got it. And Ted, how about you and your colleagues at B. Riley? What sectors are you watching most closely?
I think, consumer goods and more specifically maybe grocery store chains, because margins are so thin to begin with, and now with transportation costs increasing due to the lack of qualified drivers out there, there's a huge shortage of drivers. That costs have skyrocketed in that space. So grocery stores are feeling the impact because they're only 4 to 6% margins to begin with, and any increase in costs really hampers them. And so we're keeping an eye on some of those names.
Interesting. Thank you. How about you, Andy?
We have two sides of our business. We have an asset-based lending business. We have a lender finance business. On the ABL side, we think there's an interesting opportunity in retail where most people are stepping away from it. We think there are companies that are going to be viable in a wind down, so you're going to be able to help them work through that process. And then there are also companies who have a real online presence, but they have to right-size their brick and mortar. And so we're looking at that more in the mid-sized company. We think the bigger players where they have a brand recognition and people are naturally going to transition from walking into the store to walking to their computer to see them, that's already played out a pretty good bit, but there's some nice mid-sized retailers we think we can probably look at. On the lender finance side, we've backed away from the consumer paper side of the business right now. We're just not certain as to which direction that's going to go. An interesting shift, if you would have asked me 12 months ago, we would have been looking at the BDCs as an opportunity for some disruption with the abatement or even decrease by the Fed in rates. We think that story may change, so we're trying to figure that side of the business out as well.
Got it. Deirdre, I'm going to skip you because I have a question I want to come back to you in a second about. But how about you, Duncan?
Well, I think there's a number of areas we're thinking about. I guess I call them pockets of pain, is what I call them. There's obviously retail.
Good headline.
Yeah, retail across the board. I think there's, Randy talked earlier today about disruption. I think that's what we're seeing in retail. And I think any consumer-facing business, anything with a storefront, a restaurant, right? For example, retail location, they're facing disruption to their model. There's a tremendous disruption going on in restaurants today because of third-party delivery services. It's sort of the Uber effect, DoorDash, those types of businesses I think are vying to take the brand away from individual restaurants. And that now, these third-party delivery services are trying to, basically, they're now the menu, if you will. You're hungry at night, you're leaving work, say, okay, what do I want to eat tonight? You turn to Uber Eats, or you turn to DoorDash, and you look at what's available. You're not necessarily thinking about what food you want to eat before you turn to that. And I think that's a big transformative sort of shift that's going to take place over the coming years, and I think it's going to cause a lot of disruption in restaurants. Restaurants are always disrupted, but that's going to be another area. I think we're starting to think about auto again. We've been out of auto for a while. We did a lot of investment in auto in the early 00s, before 08. We rode through the 08, 09 sort of period of time where we saw no production of cars there for a while, and some of our suppliers. That was a heck of a ride to go through that. I think that auto is going to continue to face some headwinds. So volumes this year are sort of soft. We're seeing building in inventory. I think we're going to see pressure on tier ones and tier twos supplying those industries, and I think that that's an interesting area that's going to start giving more business to the folks in the room.
Wow. Keep watching auto for sure.
Yeah, I think there's going to be interesting stuff there. And there's a lot of other areas too. I think food in general, I think you referenced that. I think that's in general. I mentioned restaurant, but the whole food chain, supply chain delivered to a consumer is under stress.
Thank you. One thing my team at Bloomberg has been covering a lot is litigation as it plays into restructuring. Thinking of examples like Windstream, Neiman Marcus, and PetSmart. Deirdre, I wanted to ask you how that's affected your work and whether you see that as a trend that'll continue into 2019 and beyond.
I think it has affected our work because, historically, let's just say like the last 36 months, we've seen just a flood of pre-packs, right? So, I think when you add litigation to the mix, that's going to derail any prearranged procedure. So I think it's very difficult to trend litigation in bankruptcy because it really is testing out the financial advisors and the lawyers' creativity in bankruptcy. So it's hard to forecast trending, but if you look at Windstream, you look at PetSmart, you look at Neiman Marcus, they're hotly litigated big gating issues, and I think that we will continue to see that as we head into a more recession-like environment.
Well, I think the prospect of litigation for PG&E created a big opportunity for the restructuring world. I think so. Litigation, I think, is always at play in certain situations, right? I mean, that PG&E bankruptcy is a massive deal. I don't know how many people in the room are involved in that. I know that like Alex is involved, right, Carrie Ann? So that's a lot of people that have gotten onto that gig, and I think so. Big ticket litigation, stuff like that. That's another one of these disruptors that Randy was talking about. Not so much from the internet side of things or that kind of way, but certainly it adds to opportunity for folks here.
Interesting. Does anyone else have any views on that?
I was going to say, just on litigation, I think a lot of that's driven by some of the things we talked about earlier, which is you have more complex capital structures, very, very highly leveraged companies. And so, people are, if you have to file bankruptcy, people are using litigation in order to try to drive a recovery for themselves when they're out of the money or close to out of the money. And so I think you actually see a lot of deals, whether they're structured as pre-packs or you're just trying to get them done outside of bankruptcy court. So you actually don't create that forum to allow litigation to happen, which can ultimately derail a case just because of the cost associated with the litigation.
Interesting. Thank you.
One area that we didn't touch upon on industry sector, and it relates to Nancy's expertise, is pharma. We've seen startups, we've seen small pharma companies file for Chapter 11. Many of them are on the heels of being administratively insolvent, which is unfortunate. And then you have the much bigger companies in the opioid chain. And I think we're going to see a ton of activity there. The bigger companies who are constantly in the capital markets, strong issuers, are going to survive. But if you look at the opioid chain, and particularly the multi-district litigation, there are many, many companies in that chain that I don't believe have the fortitude to make it through the hump.
Wow.
So just wanted to add that to the mix.
Another one to watch.
Yeah.
Since we have such a nice range of professionals here, I was hoping to hear from people about how your role has changed in the past year, what kind of things clients are asking for, and then kind of looking forward into 2019, what do you expect clients to be asking for more, in the coming year or years?
I'll let someone else go first.
I don't really have
I'd
clients.
rather conclude.
Yeah, so I'll start because I have clients, or I always hope to have clients. So I think just from a strategic perspective, I think what I just said before is clients are looking for a business solution to the case. I again tend to be on company side or buyer side. So buyer clients, which are usually private equity funds, come to us and say, I have this deal. I'm really interested in it. How do I get that deal done outside of bankruptcy? So we're basically, spend a lot of time trying to analyze how much risk you're going to be willing to take. If you're not going to necessarily get a nice, free and clear, sale order out of a bankruptcy court, so how much risk is that client willing to take? And then how is the client going to orchestrate that transaction and not have to go through a lengthy auction process? So can you buy into the capital structure? Where can you flip that to ownership? Are you going to buy the company and be the lender for a year or so to kind of right-size the company and then flush it through a bankruptcy process quickly and become the owner? So we look at all those types of strategies. On the company side, I will say, as an example, last year, going back to lots of money in the marketplace, we had a small family-owned business out west that, I mean, when we got involved, they were going to miss payroll, which is a common problem. I'm not sure why clients call us when they're about to miss payroll as opposed to well in advance of that, but going to miss payroll. We convinced the bank to over-advance to cover payroll, and then we started a marketing process. So that's a company that I would have expected to possibly close down, maybe not even make it into bankruptcy. We ended up with 6 offers that came in on a sale process. We got offers from lenders to refinance the debt and provide additional liquidity. We got offers to buy the assets, as you would expect, and take it through a bankruptcy process. And then the offer that we took, we actually got 3 offers where a private equity fund was going to come in and buy a majority stake in the company, leave the family with a minority interest, and also create a cash distribution to the family at closing. So, I mean, this was a situation, you're looking at the company, it really struggles to compete because it gets a lot of pressure from imports from China, and it was able to, ultimately the family walked away with a nice check, a nice piece of equity, and they also still own all the real estate that they lease back and have an ongoing income stream. So from company perspective, great outcome. It was surprising to me as a restructuring lawyer.
I would say from a lender's chair, what do our clients want? They want more liquidity, cheaper pricing, looser covenants, and just an easier deal. And what that is a race to the bottom and a commoditization of capital. And I understand it from everybody's standpoint, the user of that capital wants that. I think it's a dangerous place to be because usually when you get to the bottom, you have the least sophisticated lender. Therefore, when you stub your toe, there's a knee-jerk reaction. And so we've spent a lot of time talking to clients about why they should do business with us, how we react in tough situations. And we frankly tell them, look, here's a list of every deal we've ever done. Here are the ones that worked really well. Here are the ones that had a little bit of issue. We'd encourage you to call the ones that had an issue because we think it's important that you partner with somebody who has the level of sophistication that allows you to work through the issue and not immediately say, well, we're throwing our hands up, we want you out, create a bigger problem than there already is, and head down the bankruptcy path. So our role has really changed in the sale process to say, how do we really add value and to lay that on the table and make sure people understand it.
And to that, my role would be to call the Andys of the world and make sure that my client finds the proper restructuring out of court or a refinancing out of court before we go down the path of a bankruptcy. Because a lot of times we're able to avoid it because, as we said earlier, that there are a lot more debt funds out there that are willing to do certain transactions that probably couldn't be done 10 years ago because there's so much liquidity out there that these deals get done. And you have to find the right deal with the right lender that will be with them going forwards. But if not, we call Nancy.
I'll give you just a real quick example. We got a call from a turnaround consultant that we've done a lot of business with, have a ton of confidence in. And they said, listen, the bank is literally getting ready to liquidate this company. We think there's a viable business there. Can you come look at it? We went out, visited the company, went to the bank and said, look, if you give us 30 days, we think we're going to get through the diligence. You'll be no worse off versus your collateral at the end of 30 days. Give us that time frame. And if we can get there, you're paid out at par and you move on. We got there. That happened, we paid them out, company did well, turnaround consultant was engaged, company did exactly what they needed to do and hit all their numbers, and life was great. Knock on the door, 2 lenders there at 150 bips lower than we were, and the owner of the company called me up and he goes, I'm never going to forget that you saved my company, I really appreciate it, but these guys are really cheap. And I said, just remember what happened the last time, and this is about whether your company was going to survive or not. And yes, 150 basis points is a lot, except when they have their hands around your neck, squeezing your liquidity, how much in revenue did you lose? versus 150 basis points? And his answer was, I understand, I'm taking the money. He took the money, 15 months later called me and said, you know, my CapEx project where I was going to spend $3 million? I said, yeah. He said, I spent $6 million and the bank's kicking me out again. Can I come back? And that's the kind of thing where you have to say, listen, you really need to think through that all-in cost of capital, opportunity cost, and everything.
Did you take it back?
Oh, absolutely.
Yeah, at a higher interest rate, all right?
That's what we do.
So I work for a private equity firm, and we serve limited partner investors. Those are our clients. And their demand is that we continue to deploy capital. So even though we are differentiated from other PE shops by having this ability to do distressed deals, we are in times where few distressed deals are out there, truly distressed deals. So what we've done is, historically, we've done a lot of manufacturing, a lot of industrial businesses, a lot of businesses across the Midwest and across Upper Canada. And we've had to extend our served market, if you will. So we've looked at deals in areas that we've historically not looked at. So we've gotten into a little bit of healthcare, something that we didn't do before. We've gotten into some restaurants. We've gotten into food, an area that we tried and failed at miserably back in the mid-00s, but now we're back at it, and because we think there's opportunity there. So what we've done is we've married up our expertise in turnarounds with more industry executives that have real expertise in the businesses that we're interested in investing in. And then also, having great partners with lenders that we work with. I think that is important that you stick with folks that help you out in tough situations because they're absolutely crucial to helping us invest in turnaround situations. So what we've done is we've expanded our footprint of deals that we'll take a look at where historically we'd never look at them, but now we're looking at them.
Interesting. Nancy, you told me that with so much money in the marketplace right now, you've had to get more creative with transaction structures.
Yeah, I think we've tried, as I said before, trying to come up with different ideas for transaction structures to actually, again, avoid. I will say the one common theme I think you've heard throughout the panel is, which should always be the case, you're trying to avoid a bankruptcy filing. So you're trying to figure out how can you put together some sort of a transaction and actually execute it outside of bankruptcy, whether that's bringing in new money, new equity, a combination of those things, whatever it happens to be. So yeah, we've come up with, we did, over a 5-year time period, it was a 5-year restructuring. It was like one of the longest cases I ever worked on where we were trying to restructure tax-exempt bond debt. We couldn't get to a pre-pack. We were gonna have to run the company through a bankruptcy filing because we couldn't find all the bondholders. But we found, the major bondholders and came up with some, creative structures, at least in the tax-exempt world, to get that deal done. So I know that we were 2 days from going effective on a plan when we learned from, for example, DTC that they had never issued any tax-exempt bonds with PIK interest. So we had to go through a lot of discussions with DTC ultimately to get those registered and be able to allow those to be traded. So I think clients are looking for any sort of ideas in terms of different types of debt instruments. We've worked with some buyers where we've been able to kind of break apart assets at the time of acquisition, so we start isolating a liability that maybe we can just close down that piece of the business quietly, again, a year or so after the transaction to get rid of that liability or run it through an ABC or something like that and not hit bankruptcy court where you're gonna see more cost and more exposure. So we've looked at all sorts of things. We've done anything from a lot of receiverships, which are popular in the skilled nursing area, to private UCC sales to get deals done, where we've had lenders working with us to accomplish that. Obviously, public UCC sales using assignments and just doing these traditional asset deals and kind of fixing problems and closing down parts of the business later.
Interesting. Duncan, I wanted to ask you. You mentioned when we talked before about your. I was interested to hear your view on non-bank lenders like BDCs.
Yeah.
Can you tell us just what those are and how those act, especially in a recession?
Well, I was thinking about 2019, and I'm thinking about 2020, and I'm thinking about where we are in our quote unquote recovery from the Great Recession, and I was thinking about how things are. I think are going to start changing the marketplace. I think that December was an interesting month to ride through. We had a business for sale in December, and they couldn't close because it got hung up. because leveraged loans sort of got hung up there for a couple weeks, and I think that was really interesting. And then it got done in December still, and then stuff got hung up again, and then everything sort of cleared out in January. So I thought that was an interesting thing to think about, because even though I think the market is still very robust, I think deal prices are still very strong. I think that there are cracks starting to appear, and I think that anecdotally I've been hearing that there's a little bit more activity in workout groups, not much, but a little bit more. And I've heard from my restructuring advisor friends that they're seeing more activity, more reach outs from lenders and of all sorts. So in thinking about how all this liquidity came to market and really coming from non-bank lenders, I think that BDCs, et cetera, are sort of structured differently than banks are. They don't really have workout groups necessarily. They have the ability, however, to lend more money to a business, or they have the ability to sort of take over the business, if you will, which is a little bit different from lenders. I mean, lenders have the ability, but these guys the non-bank guys seems to have that interest in doing it. So I think that that's added a lot to how there's been this continual liquidity, even though there's been sort of restructurings. Well, we'll give you a little bit more so you can make our interest payment, and that kind of stuff has been ongoing. So when markets seized up there a little bit in December, that was pretty fast. And it wasn't like there was some kind of lead into it. It just happened overnight. And so lenders that rely on other lenders for them to have capital to lend money, I think that that's an interesting question as to how quickly, when things start to go sour, how quickly it'll happen.
Got it.
And so that's kind of what I'm thinking about. It's kind of a question to the group about what you all think about it too. But I think that when there is a turn, it's going to happen fairly quickly. And I think because liquidity will be removed fairly quickly.
Just two really quick data points on that. In the last 6 months, we've seen a 40% decrease in prepacks. So obviously, people aren't agreeing as much. And also, in the last 6 months, we've seen a drastic increase in the types of industries that are seeking protection under Chapter 11, so, pharma, healthcare, casual dining, light industrial, retail. It's just really a very broad swath across industry sectors, which indicates more systemic distress, which for those of us in the business kind of like that. Right.
Well, I have some more questions, but I also wanted to hear if there were any questions that, as each of you listen to each other talk about their work. Or do any of you have any questions for each other?
No, but I think I'm going to be calling up Nancy to figure out how to take over businesses without having to go through BK. I think that's
Happy to talk to you about that, yeah.
Call me, don't
yeah,
call
me. But the thing is that I just went through a bankruptcy, and I was shocked about how much it cost, even though it was a fairly cut and dried case.
It's not that bad.
And it was pretty expensive.
What were the specific line items that jumped out at you?
I think that there was no way that there was any money available to the unsecureds. No way. And yet, had to pay for an unsecured committee, attorney, financial advisor. And then that also causes, debtor counsel costs to go up because they got to talk to those guys. And so it just, I felt that if there was a way I could have gotten through that without having to go through a bankruptcy, I certainly would have done it.
Let's talk later.
Yeah. I've done a lot of out-of-court stuff, like UC9 foreclosure stuff, things like that, and that's much easier to do and quicker, and it's better for the business. But I thought that we'd sail through bankruptcy a little bit easier than we did, so I was sort of surprised by it.
Got it. Well, I think to give a moment for the switchover, I'd like to give a hand to our panelists, and thanks everyone for talking.
Thank you.